Okay, everyone, Gian Bavaro, your favorite residential and commercial mortgage broker right here in sunny South Florida. And I get this question all the time: how can you pay off your loan in just under 5 years? Want to find out? Stay tuned. The question I get all the time is, how can I pay off my 30-year mortgage in under 5 years? Well, I'm going to tell you about a little secret that a lot of people in the industry don't want you to know. And that secret is called your amortization schedule or amortization table. So let me explain first of all how a 30-year mortgage actually works when it comes to the principal and interest payments. Typically, a 30-year fixed loan has what's called fixed mortgage payments for your loan monthly payment. Now, what that means is let's pretend your monthly payment is $1,000 per month. Some of that $1,000 goes towards interest, and some of that $1,000 goes towards principal. Now, in the first 15 years of your 30-year loan, most of that payment goes towards interest, and some goes towards principal. And then in the last 15 years of that loan, most of the payment typically goes towards principal, and then the rest goes towards interest. So let me give you an example. Let's pretend you owe $300,000 on your mortgage today. Let's say you just closed on your home. It's June of 2023, and you owe $300,000. As you make your monthly mortgage payment, that $300,000 balance, if you're just paying the minimum, is not going to go down very fast. And so what you can do is pull up what's called an amortization schedule or an amortization table. Just look it up on Google, amortization table or amortization schedule. You plug in your loan balance, your interest rate, and how many months you have left on your loan, and it will tell you at what month. So let's say we're in June of 2023, right? And if you want to know what your loan balance will be in 1 year from now, in June of 2024, and what your principal balance would be, maybe at $300,000, your principal balance would only go down to $298,000 after 1 year of making payments. Now, if you make an extra $2,000, in this example, an extra principal payment of $2,000, that will shoot your loan from where it's at today to 1 year. It will actually knock off an entire year of your mortgage balance just by paying your principal balance, in this example, down only $2,000. Again, that was just an example, but let's say you're looking at your amortization table, you plug in all the numbers, and you see that you need to pay down from $300,000 to $298,000, for example, in this case, and in 1 year, that's what your loan balance would be. Well, if, again, you make that extra $2,000 payment, that would take off an entire year of your mortgage just by paying that $2,000 per month. And the magic key is you want to see at which point you're paying more principal than interest and what that loan balance would be. So let me give you another example. On your 30-year loan, let's say when you get down to a balance of $260,000, that at that point, most of your payments go towards principal and not towards interest. Well, then you know you need to get down to $260,000, and that will cut about half of the time off of your loan. So if you're looking to pay off your house as soon as possible, my recommendation is make extra principal payments towards your mortgage as early as possible onto your loan. And the way you do that, again, look at the amortization table and figure out. All you've got to do is plug in the numbers and see where do I need to be to make sure my mortgage payment, most of it's going towards principal and not towards interest. If you'd like more tips like that, take a look at my other YouTube videos or just give me a call, 954-334-3670. Thanks so much.